these commercial banks like Chase and Bank of America and Citi, all the ones that hold all of the derivatives in the FDIC insured banks, they are very, very exposed, right? Everything is interconnected. But how are these CLOs used? Because you need to be aware of this. They're used by borrowers with low credit quality, and they do form a risk to financial stability because they're integrated throughout the system, not just in the banks, but in a lot of the financial products. If you have ETFs, mutual funds, annuities, variable annuities, etc., if you have any products at insurance companies, you could very well be exposed to this and not even realize it. But whether you own them or you don't own them, because the system is so incestuously integrated, everybody is going to feel this. And finally, this has been an expansion into shadow banking. Now, what is a shadow bank? A shadow bank is an entity that does a lot of what a traditional bank does, except that they do not take in deposits. Now, deposits, in theory anyway, make bigger banks less risk. Well, they don't really make them less risky. I mean, once you make that deposit into your account, then they're moved into sub-accounts, and they can do as many they can do anything they want with it once that equity is in your name. But you have to understand that with what the banks went through, and I'm sure you've heard how much safer the banks are now. Well, a lot of that activity, including the CLO activity, was moved to shadow banks. So banks that do everything pretty much that main banks do, but they don't have those deposits to use as a source of funds. And this is really a key thing, and I'm gonna come back to this, bear with me, I'm coming back to it in a minute. Because now in a recent article, fire sale risk in the leverage loan market. Because prices, well, as interest rates were staying low, the prices of these CLOs kept going up. You remember how interest rates, right? How interest rates and bond principles work, right? When interest rates were going down and being held down, bond principal, loan principles went up. But now we're in the reverse circumstance. So as interest rates go up, it impacts the principal of all of these loans. Why does that matter to you? Because banks and shadow banks have valuations that are based upon the value of the loans that they hold and some other things as well. So that means as the interest rates are rising, these companies and the lenders that issued these CLO, the leverage loans, and then the leverage loans are put into, as a pool, put into a CLO, right? They are risking their value, their valuations are falling. It's just that simple as that, right? Interest rates up, principal value down. That makes it even harder to service the loans. Because remember, these are loans were given to corporations with very bad credit ratings. In fact, we've got leverage levels that frankly are rising like they did in 2006, and they're well above where they were in 2006. Here we are in leverage, right? So leverage is debt upon debt upon debt upon debt. And EBITDA, which you see here, EBITDA, earnings before interest, taxes, depreciation, and amortization, right? So I don't care what they say. Here is the evidence of the level of leverage that is in these corporations here in 2022. They can't pay these loans back. And let's see, what were those loans used for? Many of them, surging demand for leveraged loans propels dividend payouts to record pace. Dividends, right? So the payouts, once they borrowed this money, it didn't stay in the corporation to make the corporation better, to expand, to generate more money. Heck no, we don't need all that money. We can borrow it cheap and easy. They use this money to pay out dividends. That means that money went out of the corporation. So what happens if the corporation gets into trouble and they have trouble repaying these loans? You tell me, the money's not there. And you can't get blood out of a stone,